Good afternoon, and thank you for joining us for our Mortgage 101 series. Liberty Bank is the largest wholly owned African American bank in the country, and it's our pleasure to introduce everyone to how to buy a home, especially in today's rate environment. Today's rate environment has the lowest rates this country has seen in history, and it's a great time to buy a home. With us today, I have a consummate mortgage professional, Michael Lawton. Michael Lawton started his lending career in 1984 and has been involved in many facets of mortgage lending. He's worked as a real estate agent, mortgage liquidator, and a mortgage originator, as well as working in government and for policy throughout his career. Most importantly, Mike has been married for over 34 years to a loving wife and has two children who are his pride and joy. It is my pleasure to introduce Mike Lawton. Good
Hi,
afternoon, Mr. Lawton. How are you?
how you doing, Jonathan?
Doing
Great.
good, doing good. Why don't you tell us a little bit about how to start the process?
Okay. Um, First, I'm going to go back into that loving wife part. I don't know about that one, but, but anyway, just kidding. Um, anyway, my portion of this is, I guess, to let you know what we offer, what types of loans we have, what they entail. I'm gonna be brief about that because I think usually the best thing or the easy way to answer to answer things for you is for you to have questions and come back at me because everybody's got specific issues about certain things going on with them, etc. So I'm gonna lightly touch on the loan types. There are four loan types. There's an FHA, there's a conventional, there's a VA, and there's one called the Rural Development Loan. The FHA, well, all of these are unoccupied loans. The FHA is a loan that carries a 3.5% down payment. It's got mortgage insurance that is required. You can purchase 1 to 4 units on the FHA loan, and a seller can assist you in your purchase up to 6%. The 203K is an FHA loan. It's a rehab loan. There's also a 203H, which is an FHA disaster loan. That's the one that can be done at 100%, where there will be no need of the 3.5% down payment. That's the FHA category. The conventional loan has a 3.25% down payment, depending on income. Mortgage insurance on that loan is required unless you're putting down 20%. If you're putting down 10%, of course, the MI requirement will be less than it would be if you were putting down the 20%. On the conventional loan, the seller can assist you in the purchase up to 3%. Unlike the FHA, remember, which was 6%. The difference between the FHA and the conventional is on the FHA loan, whether you're buying 1, 2, 3, or 4 units, the down payment is still 3.5%. On the conventional loan, if you're going to occupy and you're doing 2 units, it's a 50% required down payment. If you are going to do 3 to 4 units, it then becomes a 25% down payment on that one. The next loan that we cover is the VA loan, just what it is. VA loan is the veteran's loan. That's 100% loan to the veteran. It's got no mortgage insurance, none is required. Seller can pay all of the costs. So all the concessions can be paid on the VA loan. The third type of loan is an RD loan. The RD loan is a rural development loan, which is pretty much a loan that can be done outside of the greater metropolitan area. I know here in New Orleans, where we are, the areas that you could do that would be like St. Bernard Parish. It would be parts of Jefferson Parish. All those areas are outside of the greater metropolitan area. PMI is required on those loans, and just like the FHA, the seller can pay up to 6% concessions on that loan. It again is 100% loan, and you can only do a 1-unit property. So you're not allowed to do a duplex, 2-unit, 3-unit, 4-unit if you're going to obtain the RD loan. We at Liberty have something else called a portfolio loan, which is pretty much a conventional loan. But it's a loan that we offer to clients that may have some issues where they would not fall into the government bracket, can be sold in the secondary market and the government's market. We do those They're board approved, case by case basis. But that's just a feature that they have here at Liberty Bank, which I think is great, because sometimes you can help someone outside of the regular paper requirements. We also do pretty much all of the soft second bond grant programs. Those programs are those deals in those programs are actually either FHA, VA, or conventional loans. There are just overlays that each of the specific programs have. Clear example for one here is let's say the Finance Authority of New Orleans, which can be a conventional FHA or VA loan. Their overlays may be, meaning that there's additional requirements. They may have an income requirement, so you can't make more than a certain amount, or the debt can exceed a certain amount, or the property has to be located in a specific area. All of those will require like home buyer training, those things. So we offer all of those programs. I know here in the city of New Orleans, there's a grant program, and the city's max is a $55,000 grant. So that would work. Say you came in, you qualified, and I said, look, you qualify for $100,000. But if you're going to buy your property in Orleans Parish and you fit the mold, you qualify with their overlays, they would give you an additional $55,000. So now you could buy for the 100 plus the 55. The 55 is actually the down payment. Sometimes it'll assist you with cost, and you get into that property that way. Investment properties, we do. Those are that's a specific conventional product. 1 to 4 units. On the conventional loan, if you're buying a 1-unit property as investment, you're limited to putting a minimum of 20% down. If you're doing 2 units plus, you're limited to putting 25% down. In those cases, mortgage insurance is not required because you're putting down the minimum of 20%. On investment properties, the seller can assist you with concessions in terms of helping you with closing costs. They're limited to helping you with 2% of the sales price on the investment deals. In most cases on the investment deals, there's also an added feature. There's something called reserves, and reserves are required in most cases on those properties. And reserves are just months of payments in the hole that you have on, that you can verify that you have on the side somewhere. I'm gonna touch a little bit on the credit scores. Government says you can do mortgage loans with a credit score of 580 and above. However, it's hard to sell, or it's hard to do those loans that are 580. We generally peak or look for something that's at least 620. Those, if you do it, it's got a 580 or 600 or 601 or 605. Usually with those deals, there's some compensating factor, usually 3. Compensating factor can be tenure on the job, funds in reserve after the project. It could be putting a large payment down. It could be months in reserve or a long-term rental history. Being able to put your hands on a 401k or something like that you have to use that as reserves. So usually when you do something that's between a 580 and say a 620, you look for those kind of compensating factors or something to offset the credit. The norm in most cases, I think of most lenders would be the 640. I know for a fact that on any of the home buyer assistance programs, the first time home buyer programs, the 640 credit score is required. So you've got to meet that before you can even apply for the program. And generally on the conventional loan, which I find is sort of the hardest to underwrite, generally you've got like a 660 and above to work on that kind of a project. I mean that's general. I'm gonna leave it open at this point, Jonathan, if you will, to questions, concerns that they may have out there.
No, absolutely. And I was wondering if we put a quarter in the meter for a second, and you could talk a little more about the use of bond programs and grants for the purposes of buying a home, including for first-time home buyers. And then could we also talk about gifts, getting gifts from family members and relatives to assist in purchasing homes or
Yeah, we can touch on that. As it relates to, let's go back to the. I guess I get a little more entail as it relates to the grant programs. In my opinion, the two that are most popular um, is the city's bond program. That's the Financial Authority of New Orleans. In that program, they actually assist you um, by giving you either 3 to 5% to go toward the down payment specifically. No cost, nothing else. Now, keep in mind in that program, if you're going with the program, the interest rates are determined by the program. You go with the program, you go with the rate. In that program, there is a 640 required credit score. There's a maximum debt to income of 45%. That would mean that all of your debt, including the new house note, could not exceed 45% of your monthly gross income. That program requires you do the home buyer training, and that's offered online now. At one time, it was not. Um, that's pretty much where you are with the bond program. As it relates to the soft second, which is a second mortgage program, where they give you up to 55,000, not 55,000, up to. They give you what you need. In that program, there's a required mortgage payment um, between 30 to 33% of your monthly gross income. That means that in order to qualify for that program, you have to have a payment that will be between 30 to 33% of your monthly gross income. That's it. No choice. Can't be below it, can't be above it. In that program, also, you can have combined debt, meaning all of your debt can't exceed 48% of the monthly gross income, which would mean that you're taking the property, the note on the property that you're going to, the payment on the property that you're buying, along with any car notes, student loans, etc. Adding that together, and that can exceed 48% of your gross in that program. In that program, they give you $55,000 in up to, let's correct that, up to $55,000 in grant. They also give you, in some cases, up to $5,000 to go toward your cost. Um, in the soft second program, you have a minimum contribution on your end of $1,500. Um, that one is limited to Orleans Parish. They do their own inspection of the property. They make sure that it passes their limited, I guess, rules as it relates to the property. Um, I'm going to say that's pretty much the nuts and bolts of the first time home buyer program. By the way, the RD program is a first time home buyer program as well. Although you could have owned property before, um, and it too is 100% program. So as opposed to giving you a grant, they're allowing you to borrow up to 100% of the sales price. So there's no down payment required in that one as well. Jonathan, you asked me about the soft second programs and something else. What was it?
well, also gift funds. I mean, what kind of gift funds are allowable? Getting help from family, friends. Talk a little bit about that.
Gift funds are gift funds are allowable not from friends but from family, from relatives. As the rules apply. Um, you can on the FHA loan and on the conventional loan get a gift for the full amount required. You can get a gift for all that you need. The only time gifts are not allowed are on the investment deals. On the investment deals, there's no gift. There's no gift giving. Um, and the gift can be again simple process. Um, the gift giver can gift the money to you. However, the money that's gifted to you has to has to be sourced, meaning that who's ever going to give you the gift will have to provide documentation showing that they had the money prior to giving it to you and that they had it at the time they gave it to you. And that goes back into bank statements. The gift giver doesn't have to give you a full month of their bank statement, but they would at least have to give you at minimum a 3-day history on their account, which should show that 3 days prior to the time that they gave it to you, they had the money and that money came out of their account. So we're going to look for two things: them having the money, A, and B, the money coming out of their account on that day. So they do have to supply that on their end. But gifts are allowable in all transactions. However, whenever we require reserves, and if we have to require reserves for whatever reason, you remember I told you about compensating factors. Sometimes reserves are compensating factors, and sometimes they're required based on credit issues, etc. Whenever we have reserves, the reserves cannot be gifted. That has to be funds that you have.
Okay.
Anything else, John?
Oh yeah, absolutely. We have lots of questions coming through. So one of the questions come through asked very plainly: is now a good time to refinance? Given that, can you talk through why now is a good time to refinance, and historically speaking, where we were with interest rates and where we are now?
Yes. In my opinion, now is a good time to refinance if it benefits you. I was around doing doing mortgages when the rates were at 14%. I think that it's always a good time to refinance if it serves your need, and sometimes it does not. Clearly, if you're going from a higher rate than what you can obtain, if you're going from I'm at 6 and right now it's 3, that makes good sense to refinance just to lower the lower the note. Sometimes it does not, because you also have to take into consideration the amount of time that you have left on the mortgage that you have. So if I had a mortgage that was, I don't know, a 30-year loan and I had 5 years left on it, and I was going to refinance and decrease the payment, wouldn't make any sense, because I'm adding on 10, 15, another 30 years. So to be honest with you, in refinancing, I usually get with the client, determine if it makes sense, tell them what I think. Everybody's case is different. Review at that point and make a decision on if it's a good thing to do. But if it's a rate and term, and you're coming from, again, a high rate to a low rate, then it's definitely the thing to do, in my opinion.
Staying with the questions around refinancing, can you talk in terms of options that are available for customers out there that are still trying to recover from Ida?
Well, I'm gonna say two things. In terms of programs that are available and we're coming from out of Ida, I'm gonna say there's the 203K, the 203H, which is FHA loan that you can do with 100% financing. But that's getting out of one piece of property going into another piece of property. As it relates to damage from Ida, if that's what the question is, and what do I do because they have damage from Ida? All I can do is say you could entertain, if you're not getting any insurance proceeds, any help from SB or anywhere else, you could entertain a rehab loan of some sort to get your property repaired. But there's no specific disaster loan out there for repair that I'm aware of. I know there's a disaster loan out there to purchase if the property that you own in a disaster or was damaged in the storm. But I would have to say that a rehab loan would be the key to put your property back together if you qualify, and if you can't get any help in any other area.
Okay. We have a question asking for you to just talk a little bit more and explain the FHA 203K product and the difference between that and the 203H.
Okay. 203H clearly is a loan to purchase a new property if the property that you lived in or rented was damaged in a storm in the area. Is considered a disaster. So that's just a purchase loan. So the 203H is a purchase loan. It's not a rehab loan. It's not a repair loan. It's to go purchase a new piece of property somewhere else. That's what the 203H clearly is. The 203K is a rehabilitation loan. It's an FHA rehab loan. That loan is designed for you to either repair property that you have via refinance and adding in costs to repair, or to purchase a piece of distressed property and repair it at the same time. So it's a purchase repair loan or refi repair loan. I think I want to say, if I'm correct, the FHA, and I may have to look up, I could be wrong. I think it might have just went up. I think the FHA max, because there's a max, I think the max might be 371. I could be wrong there. It may have just increased. But as long as you can purchase a property as it stands in its distressed state and repair it, and the cost doesn't exceed the max FHA loan, which I think is the 371, you're fine. So it's strictly a repair loan. And those were loans that were, we were flooded with after Hurricane Katrina, because everything was gutted and available. But that's the difference between the two. One is to purchase a new piece of property that does not need repair, and one is to repair a piece of property.
So we have another question about how to use the 203K product to take advantage of sheriff auction sales.
Again, now keep in mind, keep in mind now, the 203K is specifically an owner-occupied product. So it's not a way to obtain a piece of property, repair it, and sell it for property. That's not allowed. That's not what it's about. But as it relates to buying a piece of property at sale or auction, again, if you're buying distressed property at the auction and you need to repair it, 203K may be a way to go. So whether you're buying the property at auction or from an owner, that part doesn't matter. The loan is specifically about buying the property and repairing it. But keep in mind that that loan is an owner-occupied loan, and you're to occupy the property. It's not to repair the property and sell it for a profit. That's prohibited.
Can you talk through some of the common documentation someone should come and see you with up front when making an application?
Sure. Generally, what I ask for, if you come to see me, is ID, Social Security card. I'm gonna look for the last 2 paycheck stubs if you're paid twice a month, the last 4 if you're paid weekly. I'm going to ask for the last 2 years W-2s that you would have received, and the last 2 months bank statement. Now that's enough information for me to look at and determine what I can do for you, and where you can go in terms of the sales price.
What if you're self-employed?
In self-employed cases, well, glad you asked me that one. Generally, that's a hard, that's a rough category these days via COVID. Some of the rules have really changed. But as it relates to the self-employed person, I'm going to look for the last 2 years tax return and 6 months of bank statements. because I'm going to try to match up what you're showing as income, what I've averaged as income coming in for the last 3 to 6 months on the bank statements.
Thank you for that. We're approaching our ending time, and I want to give you an opportunity to share any closing thoughts you may have had for everyone.
I'm gonna say this. I find that that we all think it's really, really difficult to purchase a home, especially our first home, and it really, really isn't. It's easier than you think. I do a lot of these home buyer training classes for a lot of the nonprofits, and I find that folks become more at ease when they attend them, because a lot of things that they think they really need, they really don't, and a lot of issues that they have are issues that that you can actually work through. So I'm going to say that when you hear about if you're a first time home buyer and you hear about one of those classes, I'm going to say try to do your best to attend one of them.
Okay, good. And we have a lot more information available on our website, mortgages.libertybank.net, and information available about the bank itself at libertybank.net. Once again, thank you for joining us. My name is Jonathan Wilson. Mike, thank you for providing us with the information. And we hope you all have a great day and happy Thanksgiving.